Start with $41.5 million in cash, plus $233 million in tax shields. Add paid-in capital, and total equity is $458 million. Now weigh that against the market. With zero debt, the $205 million market cap trades at 0.45 times book value. Mathematically, you're paying less than the value of the cash and tax shields combined. The market is effectively assigning a negative valuation to the company's physical oil reserves, its producing wells, its federal leases, and its infrastructure. The company producing these numbers is Amplify Energy Corp. An extreme discount like this usually indicates one of two conditions. Either the pricing mechanism has correctly identified an existential terminal risk that renders the assets worthless, or the equity represents a deeply mispriced turnaround. To determine which scenario we are looking at, we have to isolate the headline GAAP numbers from the actual cash flows and separate the company's historical trauma from its forward-looking mathematics. The market's heavy discount is rooted in a highly destructive operating history. The current iteration of the business emerged from a $1.3 billion Chapter 11 bankruptcy in 2017. 2 years later, it executed an all-stock merger with another post-bankruptcy producer, timing it just months before the 2020 collapse in crude prices. Then came the defining catastrophic event. In October 2021, cargo ship anchors dragged across the seafloor and ruptured an underwater pipeline connected to the company's offshore beta field. Roughly 25,000 gallons of crude leaked into the Pacific Ocean. The fallout was absolute. Amplify pled guilty to federal and state criminal charges, paid millions in fines, and absorbed a $95 million class action settlement. The beta field, their most valuable asset, was forced completely offline for 18 months. By July 2025, the board installed a new CEO, Daniel Furby, with a direct mandate: shrink the company to survive. Furby initiated an aggressive fire sale. Amplify liquidated its properties across Oklahoma, East Texas, Louisiana, and the Eagle Ford. The portfolio was reduced to exactly 2 assets, California and Wyoming. The $250 million in proceeds completely eradicated the company's revolving credit facility. Management amputated half of their daily production volume in exchange for absolute financial survival. They exited the year as a structurally tiny, highly concentrated exploration and production operator with zero debt. That brings us to May 2026, when Amplify released its first quarter results, running exclusively on those 2 remaining assets. The headline metric, the number fed into automated trading algorithms, was a GAAP net loss of $38.1 million. But looking at the income statement, you can see that this loss is driven entirely by a single line item: $45.8 million in unrealized losses on commodity derivatives. In early 2026, geopolitical tensions in the Strait of Hormuz threatened global transit capacity, causing crude prices to surge toward $100 a barrel. This ledger shows the resulting accounting mechanics. Amplify had previously locked in hedging contracts around $70 to $74 per barrel. As spot prices soared above those hedges, accounting rules required the company to record a massive mark-to-market loss. But strip away that non-cash derivative noise, and the core business generated a positive adjusted net income of $5.3 million. The company did post negative free cash flow for the quarter, but this was a deliberate allocation of capital. Management front-loaded $21 million in capital expenditures to drill high-return wells at the beta field, investing cash into immediate production growth. Quantitative screeners punish the stock for an accounting anomaly, misreading a non-cash mark-to-market adjustment as a catastrophic operational failure. Shortly after that earnings report, an unexpected regulatory decision altered the underlying unit economics of the business. Effective May 1, 2026, federal regulators granted Amplify end-of-life royalty relief at the beta field. This model tracks the immediate impact. The government slashed the royalty rate on those offshore leases from roughly 25% down to 12.5%. For every barrel pulled from the ocean floor, Amplify keeps 12.5 cents more on the dollar, injecting an estimated $1 million of pure zero-cost revenue directly to the bottom line each month. But the relief comes with a strict contractual ceiling. If oil prices sustain above $79.65 per barrel, the concession instantly evaporates, and the royalty rate snaps back to 25%. High oil prices trigger a built-in counterbalance. If oil stays elevated and the royalty relief is lost, the company's legacy below-market hedges expire month by month. Those barrels reset to spot prices, slowly unlocking $40 to $45 million in trapped value over the next 2 years, replacing the lost value and restabilizing the margin. These two mechanisms operate on different time horizons. The hedge rollover provides a temporary, one-time catch-up, while the royalty relief offers ongoing structural margin expansion as long as prices stay below the cap. Together, they create a unique structural floor. The company has functionally insulated its cash generation on both sides of the commodity curve. That cash generation is weighed against severe single point of failure concentration risk. 100% of the revenue from the beta field relies on a single aging underwater pipeline, the exact same pipeline that ruptured in 2021, operating in a highly hostile regulatory environment. Furthermore, the company carries a $170 million off-balance sheet exposure in decommissioning surety bonds. If the surety company demands cash collateral due to deteriorating financials or an operational incident, Amplify would be forced to post capital that vastly exceeds its $56.5 million in total liquidity. Yet, in the face of these localized, catastrophic risks, C-suite executives, including the CEO, CFO, and chairman, have aggressively purchased shares on the open market using their personal capital over the past 12 months. The individuals making those purchases possess a very specific skill set. This board and management team are deeply specialized in distressed debt and corporate restructuring. They are operators who dismantle and package assets, not long-term production growers. Looking at this cap table breakdown, you can see the shareholder register shifting to match. Quantitative funds have systematically exited, replaced by heavy ownership blocks from event-driven, activist funds like Fir Tree and Brigade Capital. A zero-debt, two-asset company with a clean balance sheet, guided by restructuring specialists and backed by activist blockholders, is the exact architecture you would build to maximize optionality for a strategic transaction. The Amplify thesis maps out as an exercise in extreme asymmetric probability, generating a sharply bimodal distribution of outcomes. On the downside trajectory, a mechanical failure at the offshore pipeline, an adverse regulatory ruling, or a surety bond collateral call rapidly compresses the equity value towards zero. The margin for error is non-existent. On the upside trajectory, federal royalty relief and hedge rollovers drive sustained free cash flow, allowing the restructuring-focused board to execute a strategic sale. In that scenario, the valuation undergoes a severe re-rating back towards its actual book value. The immediate scorecards for investors are clear: second quarter free cash flow figures, the operational success of the remaining 2026 wells, and the institutional positioning revealed in the next cycle of 13F filings. Additionally, the company recently secured carbon capture certification at the Bairoil complex. If carbon sequestration economics mature, that infrastructure provides entirely unpriced optionality that the market currently values at exactly $0. Trading at roughly half its book value, the market is heavily pricing in the company's historical trauma. Relentless operational execution is the only mechanism that will force the valuation gap to close.